Every middle-class person dreams of owning a car. Buying a car marks an important phase in one's life. Maruti Suzuki was the first company to realize this potential in the Indian market when Suzuki Motors of Japan decided to produce cars in JV with Indian government. Maruti brought in a revolution in the Indian passenger cars with the launch of its iconic Maruti 800 model, which had a compact, futuristic exterior and was based on cutting-edge technological platform, a far cry from the obsolete models available to Indian consumers in early 1980s. Since then, Maruti cars have ruled the Indian roads. These garnered a market share of around 62% of the Indian passenger car segment by calendar year 2000. In its existence of over 3 decades, Maruti has launched 14 models of passenger cars and utility vehicles, with close to 140 variants, thereby offering a comprehensive range of affordable cars to Indian consumers. Maruti's strengths also includes its wide distribution network. It has service stations in 1,450 cities and sales offices in close to 1,100 cities across the country. Despite aggressive entry of global automakers like Nissan, Ford, General Motors and Skoda, Maruti has managed to sustain its leadership position in the Indian passenger car market. In the past 1 decade, the Indian car market has seen the launch of more than 40 models across segments, ranging from mass-market entry-level hatchbacks to mid-size sedans and luxury cars. Despite the competition, Maruti still commands over 50% market share of Indian passenger car market and reported record sales of 1.17 million cars in the last financial year. It has grown at an average growth rate of 9.5% in the past 10 years, ahead of industry growth rates. The growth has been driven by the huge success of its models, like its hatchback car Swift, entry-level sedan Desire, and entry-level models like Alto, WagonR, and Celerio. With its wide range of models and extensive distribution network, Maruti is well placed to grow its volume sales at healthy rates over the coming years. Car penetration in India is still very low. Car density in India stands at around 13 cars per 1,000 persons, as compared with 34 cars per 1,000 persons in China, and more than 50 cars per 1,000 persons in many South Asian countries. The penetration levels are likely to improve in India in line with the growth in the economy and the increasing spending power of the growing and aspirational middle class. There are also many near-term catalysts that would provide a boost to demand for cars in India. The economic conditions are also turning favorable to support a robust uptick in discretionary spending, given the sharp moderation in inflation, lower fuel prices, declining interest rates, and steady job market. The urban consumption would also get a boost from the expected 25 to 30% hike in salaries of over 2 crore central and state government employees with the implementation of the 7th Pay Commission's recommendations. After the announcement of the 6th Pay Commission's recommendations, Maruti witnessed a sales growth in excess of 20% annually for 2 straight years. Along with a strong growth in revenues driven by a healthy growth in volume sales and better realizations, the outlook for Maruti's profit margin is also positive. The depreciation of Japanese yen against the US dollar aids Maruti's margins as it reduces its import bill, which is around 15% of total expenses related to imports of auto parts and payment of royalty to its parent, Suzuki Japan. Consequently, we expect Maruti's profit after tax to zoom by close to 80% in the 2-year period from FY15 to FY17. This would make it one of the fastest growing auto companies in the country, with a reputed management and enviable positioning in the Indian car market. Maruti has been a wealth creator for long-term investors and would continue to do so. Given the strong product portfolio, dominant market positioning and reputed pedigree, we have been positive on Maruti. We view the recent correction, driven partially by market conditions and expectations of adverse impact of volatility in yen, as an opportunity for investors. We retain our buy rating with a revised price target of Rs 6,430. We at Sharekhan have been positive on the stock and believe that it should be bought by investors with a long-term outlook and desire for stable returns. It is a must-have stock in a long-term portfolio.